Well, welcome everyone, and thanks for taking the time out of your busy lives today to join us for this special presentation. My name is Jason Choy, and I'm InvestNow Senior Portfolio Manager, where I am primarily in charge of managing the investment offerings we have on the InvestNow platform, including those on the InvestNow KiwiSaver Scheme, as well as our in-house range of funds, the Foundation Series funds. Today, I'll be hosting this exclusive webinar entitled InvestNow Presents, an introduction to the InvestNow KiwiSaver Scheme. This webinar will provide an overview of InvestNow's innovative KiwiSaver scheme and how we've designed it to provide New Zealanders with greater value and flexibility when it comes to managing their KiwiSaver investments. For some housekeeping, please note that this webinar is purely for educational purposes only, as InvestNow does not provide any personalized financial advice. We are, however, strong advocates for it and actively promote the benefits of seeking personalized advice from qualified advisors external to InvestNow. So with that out of the way, let's dive into the presentation. So on the agenda today, I'll first outline the key flaw that New Zealanders face with traditional KiwiSaver schemes, and then provide an overview of the InvestNow KiwiSaver scheme and how it's designed to address this flaw. I'll go into the key features and benefits of the scheme, which will include a discussion of one, the broad suite of managers that we have on the scheme, which enables investors to access the benefits of fund manager diversification. Two, the super cost-effective fee structure utilized by the scheme. And three, the unique ability to customize your KiwiSaver solution through the wide range of managed funds that we have available on the scheme. I'll then walk you through a case study of how investors could potentially generate more efficient returns whilst taking on less risk by leveraging the scheme's ability to combine funds and managers. I'll then outline who the KiwiSaver InvestNow KiwiSaver scheme is designed for, and also break down how super easy it is to join the InvestNow KiwiSaver scheme through our online secure portal, before finally opening up to a live Q&A session at the end. So if you did have any questions about InvestNow and our KiwiSaver scheme, please fire them through in the comment box on your right, and we'll aim to address all of these at the end. So without further ado, let's kick in. So first, a bit of background on KiwiSaver. So when the government first created KiwiSaver back in 2007, there was unfortunately a key flaw in its design. Rather than allowing Kiwis to put their hard-earned contributions towards any and all fund managers registered within KiwiSaver, which is a common practice in the rest of the developed world, KiwiSaver was instead designed so that New Zealanders could only invest into one provider's offerings at any one time. This generally meant that Kiwis were limited to investing in just one manager's set of funds, which forces New Zealanders to take additional risks as they're putting all the KiwiSaver eggs into one manager's basket. We've likely all heard of diversification, or the concept of splitting your investments across asset classes to manage risks. Well, the same concept applies when allocating to fund managers as well, as each fund manager has different strengths and weaknesses. And it isn't easy to pick a single manager that will be a winner from the get-go and continue to do so in all market conditions. So diversifying amongst fund managers is a common way that many professional investors, such as the New Zealand Superannuation Fund and ACC, utilize to manage this risk. Otherwise, being invested with just one manager introduces single manager risk, which can potentially hurt Kiwis, as firstly, you are completely exposed to a single manager's performance. So if you unfortunately selected the wrong manager, or the manager that persistently underperforms relative to their peers, then this negatively impacts your portfolio. You're also exposed to single manager bias. So every manager has their own preferred investment styles and philosophies. Some styles seem to do well within specific market cycles and worse than others. So who's to say that any one approach by a single manager would prevail in all market cycles? Finally, by being invested with just one single manager, you're also limited to just one manager's expertise. So no one manager has a monopoly on good ideas. There are various ways to skin the cat in the investment game, and so there's an opportunity cost here, as you could be missing out on innovative ways of investing by only being exposed to a single manager. So as KiwiSaver is now in year 16 and old enough to get a driver's license, people are starting to see some substantial balances. And also with KiwiSaver projected to be many New Zealanders' biggest asset, we felt it was imperative that Kiwis should be able to apply the same tools used by big institutional investors to mitigate their risks against single manager risk. This is why when InvestNow designed our KiwiSaver scheme, we specifically built it to sidestep KiwiSaver's biggest flaw and give investors the power of and. So rather than having to choose between investing your KiwiSaver in Fisher or Pathfinder or Milford, with the InvestNow KiwiSaver scheme, you can invest with your KiwiSaver with Fisher and Pathfinder and Milford, or any combination of the 15 different fund managers that we have on the scheme. So despite KiwiSaver's inherent one provider flaw, InvestNow's clever little innovation of partnering up with a whole bunch of leading managers and including their funds onto our standalone KiwiSaver scheme means that all Kiwis can benefit from fund manager diversification and spread their KiwiSaver eggs across many different baskets. So with that in mind, let's have a closer look at the key features and benefits of the InvestNow KiwiSaver scheme and understand what makes it just so unique. So within the InvestNow KiwiSaver scheme, New Zealanders can, one, take advantage of the benefits of fund manager diversification by investing in any combination of the 15 leading local and global fund managers that we have on the scheme. They can also tailor their KiwiSaver portfolios to meet specific goals and constraints through the 40 different managed fund options across a variety of asset classes and investing styles that we offer. Finally, Kiwis can also benefit from one of the lowest cost KiwiSaver schemes in the market, which charges no additional KiwiSaver admin charges and with fund management fees starting from as low as just 3 basis points per annum. Let's dive into each one of these features a little bit more and understand just how each of them enables New Zealanders to get greater value out of their KiwiSaver. So most traditional KiwiSaver schemes offer just one manager to invest with, while the InvestNow KiwiSaver scheme offers investors unparalleled access to 15 different managers. Each manager naturally has their own unique approach to investing. Fortunately though, InvestNow has partnered up with a wide spectrum of managers to cover most investing needs and styles. This includes some of the biggest players in New Zealand, such as Milford and Fisher, who are both well-known, diversified, active managers. But we also equally offer more specialized local boutique managers such as Pathfinder and Salt, who also offer diversified funds within our scheme, but with an added ethical or ESG lens to it. For those that are more cost conscious or primarily after passive exposure, we also have the in-house Foundation Series range, which offers funds with some of the lowest in-class management fees, along with the ever-popular Smart Shares range of funds as well. Equally, we have many single sector managers that are focusing on being experts in any one particular asset class or way of investing. For example, we have Antipodes and Te Ahu Mairangi, which both offer just global share funds, but they have been some of the best performing funds in the KiwiSaver market recently. While the likes of Harbour and Mint are also popular options, spanning across fixed interest and Australasian equities. We also have global investment powerhouses like Russell Investments and Mercer on the scheme, reflecting that they too are big fans and utilize the multi-manager investing approach, just like what we offer within InvestNow KiwiSaver through the power of and. So let's dive into this piece a little bit more. So what's really special about the power of and, otherwise known as fund manager diversification or multi-manager investing? Well, studies have shown that by utilizing multiple fund managers to achieve your investment goals, you are able to, one, reduce the volatility of your returns, two, benefit from the reduced dispersion of your portfolio values, and three, benefit from the synergy of different investing approaches, which altogether will lead to more consistent investment outcomes. This reflects the fact that the performance of any one manager can often differ significantly from their peers, even if they operate within the exact same asset class or utilize the exact same investing style. If you see the graph at the bottom here, which breaks down the dispersion or the range of one-year returns between top and bottom quartile managers within the same asset class, you will see some substantial differences, especially amongst the equity asset class, where global shares in particular can have a whopping 7% return difference between the top and bottom quartile manager. Remember as well, this is the difference between quartiles. So if we take the difference between the absolute best performing and the absolute worst performing manager, the difference will be even more pronounced. And it really highlights the risk that you have of investing within an underperforming manager. Furthermore, it is important to be aware that the data in this graph is only for 1 year. And even if you did happen to pick the best manager for that 1 year, there's no guarantee that they will continue to be one of the best managers in subsequent years. This reflects the fact that managers inherently have investment styles that do better in different investment cycles, where 1 year's outperformer can be inevitably next year's underperformer. This is also why you'll often see at the year-end investment awards, for example, that fund manager of the year for 1 year is often displaced by another fund manager the following year. Because there's such a substantial difference in manager performance, many investors would not prefer to take the risk of going with just one manager and potentially picking the worst or underperforming manager, and therefore would invest across a few different managers and spread that risk. Investing across different managers will naturally provide a more centralized return due to the averaging across the different managers. So let's have a look at what happens to your risks and returns when you do go for a multi-manager setup versus just a single manager. So on this graph on the left, which charts the return profile for a single manager versus multi-manager across global shares, global bonds, and Australasian equities, look at what happens to the distribution of returns with a single manager, which is on your left, and the multi-manager, which is on your right. You will notice that for each asset class, the average returns given by that little light blue line at the 50th percentile with the multi-manager setup is always at least on par, if not better than the single manager's average as well. But the dispersion or the range of returns is much lower with the multi-manager approach. So this reflects that investing across different managers will naturally provide more centralized return and less volatility to any one manager being an outlier, i.e. either them being a super high performer or an ultra low performer. In the investment industry, if your returns are less volatile, that means you're taking on less risk. So if you are able to achieve a similar average return with less risk, this means that fund manager diversification allows you to achieve better risk-adjusted returns or the return generated per unit of risk. So we go into this a bit further in the graph on your right here, which basically charts the risk-return ratio of a single manager versus multi-manager. So you'll notice here that across the board, the multi-manager setup provides a higher information ratio, which is just a fancy word for a measure of risk ratio. And more formally, it's defined as the exit return generated per unit of risk. The increasing returns per unit of risk taken is often the gold standard that professional investors seek. If you're able to achieve similar amounts of return or higher for the same amount of risk, then you're basically struck gold. And essentially, this is what the graph is showing you on the right. You'll notice that across global equities, global fixed income, and trans-Tasman equities, the range or the risk return ratio is a lot higher with the naive manager. So even the bottom performing ones is a lot higher and the top performing ones is a lot higher. And equally right in the middle as well, you'll get an average risk adjusted return that is higher with a multi-manager approach, which really highlights the benefits of the power of AND. Moving on now, another key feature of the InvestNow KiwiSaver scheme is its super cost-efficient fee structure. So unlike other KiwiSaver schemes, which can charge you a whole bunch of fees, including annual KiwiSaver administration fees, cash administration fees, platform fees, minimum account balances, you name it, the InvestNow KiwiSaver scheme has zero additional charges. So this means the only cost that you incur as an investor is purely the fund fees charged by the funds that you choose to invest in. So these are fees charged by the managers themselves and would be the same if you were to invest directly with that manager. In other words, InvestNow doesn't charge any additional markup on the fund fees either. You simply get what's advertised on the tin. At InvestNow, we also strive to cater to all investor fee preferences, where we offer funds with some of the lowest management fees available in KiwiSaver, starting from just 3 basis points per annum. Because you only pay the fees for the funds that you want, you can fully control for the cost of your investments. So if you wanted to pick a cheap and efficient passive fund, then you pay a cheap and efficient price. Pick a vigilantly managed active fund, pay a vigilantly managed price. Pick a combo of fund options, then you simply pay the weighted average of those funds, not the cumulative. The other core benefit of the InvestNow KiwiSaver scheme is the 40 different managed fund options across a variety of asset classes and investing styles that we offer, which allows investors to tailor their KiwiSaver portfolios to degrees traditional KiwiSaver schemes can only dream of. Within the 17 diversified and 23 single sector fund options, there are also funds that offer efficient passive exposure, well-researched active exposure, as well as ethical options. The next couple of slides here breaks down the various options that we have across the fund range, along with their fees. Note that in addition to the standard annual management fee, some funds will also have transaction-based fees, either in the form of a buy-sell spread, an entry-exit fee, or a swing pricing adjustment. which all essentially do similar things in that they're reducing the amount of your investment by a certain percentage to cover the cost of transacting. Furthermore, a small handful of funds will charge performance fees, which is essentially a profit sharing mechanism in years where the fund outperforms over a certain threshold. Additional detail on the full nature of the fund fees is available on the InvestNow website, but I'll also provide a few links at the end of this presentation as well, or equally happy to answer any questions related to fees in the Q&A section. So you can see that within our diversified fund range, we have a broad suite of options across aggressive, growth, balance, and conservative profiles. Within our single sector fund options, we have various options across global and Australasian shares, international and New Zealand fixed interests, along with property and cash options. Given all the different fund managers' expertises and charges involved, the bottom line here is that there is no single way that is considered the best way to invest. But because there are so many options to mix and match, there is bound to be some combination to fit most investor needs. For example, are you primarily a fee-conscious passive investor, but would like to have a little bit of ethical in your portfolio to do better by the world? Well, you could do a core satellite approach to investing, where you have the majority of your allocation in a low-cost fund, such as the Foundation Series fund, while also investing into a smaller proportion into the SALT Sustainable Growth Fund for their ESG flavor. Let's move on now and see how we can apply these key unique features of the InvestNow KiwiSaver Scheme into a real-world scenario to achieve more efficient portfolio outcomes. In this case study, we're going to walk through a worked example where we'll see how an investor could maintain exposure to the diversified growth profile, but better achieve risk-adjusted returns by unleashing the power of AND, using multiple diversified growth funds available within our scheme. Note that the principles here apply if you wanted to do a balanced exposure instead, or pure global shares exposure. We've simply chosen a growth example in this case because we feel it's probably more relevant to KiwiSaver investors, given that diversified funds tend to be popular on KiwiSaver, as they have a nice mix of shares and bonds for asset class diversification, but also because KiwiSaver isn't accessible until age 65, so most investors would have a long-term investment horizon and naturally geared more towards a growth type option to try and maximize their nest egg. So for the case study, I've plotted the 1-year risk return profile of all the growth funds on the InvestNow KiwiSaver scheme, with risk on the bottom on the x-axis being how volatile your returns have been, as calculated by the standard deviation of your returns, while performance or returns is on the y-axis, being the 1-year return to 30th June 2023 on an after fees and before tax basis. You'll notice amongst these 8 managers, there's a wide spectrum of risk return profiles here, represented by the blue dots. Even though they're all invested into diversified growth funds, some funds provide a higher return for a lower level of risk and vice versa. Note, however, that this doesn't necessarily mean that any one fund is going to consistently be the best or the worst, as it could simply be down to a particular style that happen to outperform or underperform given the current market trends. For example, a more growth-orientated investor would have done quite well so far this year, given tech stocks have basically shot through the roof, whereas that same growth investor would have had a nightmare last year when everything basically went down by 50%. The tricky thing is, it's hard to predict how long specific market cycles will last for and which managers will or won't do well within those specific cycles. So if you were invested into just one of these managers though, and their growth fund, then it could realistically be the case that that manager's specific style continues to underperform as the market cycle continues to get stretched out. So there is a risk there of being exposed to just a single manager's performance. So to mitigate that risk against choosing a persistently underperforming manager, what we could do is combine a few different growth funds together, which will ensure that we aren't fully exposed to any one manager underperforming. So what happens here with this big red dot is that we are able to achieve a moderate level of return, but for a lower level of risk by simply combining all 8 of those growth funds in equal weightings. If you compare this big red dot compared to the dots underneath it, to the right of it, you'll notice that this has a higher expected return for a lower level of risk taken, or in other words, better risk-adjusted returns. The reason why the risk is lower is by investing into a few different managers, is that you inherently are able to erode out the volatility of those returns. And rather than potentially getting the higher highs or the lower lows of any single manager, by having a few managers across the board, then your returns will just by definition be more moderate or in the middle. By having less outliers though, this does reduce the volatility of your returns. So although the nature of multi-manager investing means that you won't get full exposure to a manager that does outperform, like the ones at the top, this is by design though, and many investors would argue that this isn't inherently a drawback of multi-manager investing. So now the analogy that we like to use is being similarly exposed to just a single stock, for example, Tesla. So yes, if we had our entire portfolio in Tesla so far this year, then we would have enjoyed a 150% portfolio gain so far. A shame most of us probably missed out on that, right? But if you were to also be entirely invested into Tesla last year, your portfolio also would have dropped 65% in 2022 alone. So for most people, they don't have the entire investment portfolio with just one stock, because while they will give up the super high highs, they're also insulated from the ultra low lows, and that's what they're comfortable with. And this is why we diversify in the first place, because by definition, diversifying means that we have a more smooth or middling return, which is by design, not inherently a drawback. So it's the same concept that we're applying there, but with your fund managers instead. So the key thing to understand here is that although the fact that we have combined a whole bunch of these growth portfolios, and the average fee that you'll pay would just be a simple weighted average, along with your growth exposure will be a simple weighted average. In terms of your risk-adjusted returns, this is actually above average. And this reflects the fact that because you're essentially getting rid of the outliers, the volatility is a lot less, so your risk-adjusted returns is a lot higher. I'm conscious though that for many people, investing into 8 different funds may seem a little bit like a lot to manage. So the good news is that studies have also shown that you can achieve a sufficient level of manager diversification with less than half of this. So there's a diminishing marginal returns element at play here with adding more funds, with studies showing that by investing in just 3 funds, you can achieve a similar level of manager diversification at around 50% reduction in your dispersion of your portfolio value, while adding 5 funds gets you to about 60% reduction and 10 funds to 70%. So for me, somewhere around 3 to 4 seems like the sweet spot of being sufficiently diversified from the super highs and the lows, but also being administratively just a lot easier to monitor and think about. So the full fund portfolio selected here just spreads out the risk equally amongst Fisher, Milford, Pathfinder, and for my full active growth with a little bit of ESG. And I also checked in some foundation series in there as well, because I'm a somewhat cost conscious investor. So you'll notice with this smaller 4-fund portfolio, given by the big green dot in the chart there, you get a very similar amount of risk exposure, or the returns are a bit higher here. And this is purely just down to the managers selected being a bit better in this market cycle. The key takeaway from this though, is that there is strong value in getting better risk-adjusted returns, as it insulates you from being stuck with any one underperforming manager. So even if it means that you give up a little bit of the potential upside, over the long run, by having a more consistent average return, this will allow your long run returns to better compound over time, rather than some years doing poorly and others doing really well, where if the poor years come on super early, then this can have a drastic impact on your returns due to the impact of compounding. So if all these benefits of the InvestNow KiwiSaver scheme sounds appealing to you, then you'd also be pleased to know that joining the InvestNow KiwiSaver scheme is also super easy. All you have to do is submit your online application through our website, select what assets you'd like to invest in, and you're done. All this takes just 2 minutes to complete, and after that, we'll handle the rest for you and let you know once your KiwiSaver transfer to InvestNow has been completed, which generally takes around 10 days, but can be a bit earlier. You can also manage and change your investments and asset mix through this online portal, alongside viewing your portfolio performance. So to summarize this all, InvestNow has designed our KiwiSaver scheme to address a key flaw in the traditional KiwiSaver scheme market, and to better equip everyday New Zealanders with the tools that they need to make the most out of their KiwiSaver. So if you're after the expertise and risk mitigation benefits of multiple managers, or you're just conscious of fees and costs, or you're just wanting more choice and flexibility to tailor your KiwiSaver to your needs, then we strongly believe that the InvestNow KiwiSaver scheme is worth considering, as it is ultimately designed to allow Kiwis to get more out of their KiwiSaver and provide better futures for all. So this brings me to the end of my slides, and I hope you all found that helpful. If you want to learn more about the InvestNow KiwiSaver scheme, please do check out our dedicated landing page at www.investnow.co.nz/KiwiSaver-Beta Futures. And this now brings us now to our Q&A section. So if you haven't already, it's not too late to send through any questions that you might have in the chat box on your right, and I will try my best to get through as many of them as possible. I think we've booked in around 20 minutes or so for this. So if anyone wants to start firing through some questions, then I will start having a look at this. I guess the only key thing to highlight once again is that, as stated earlier, at InvestNow, we don't provide any personalized financial advice. So everything stated here in this presentation, as well as in this Q&A, will be limited to educational, illustrative, or factual material only. And it's up to you as an individual investor to make the most and to make your own investment decisions. Equally though, we're a proponent and would recommend customers seek personalized advice. So without further ado then, let's kick in. Let's see. Our first question relates to the transfer from one provider to another. How much would this cost? Yeah, that's a great question, and it's one we get very often as well. So when you're transferring from one provider to another, it doesn't cost anything. So all you have to do is simply just sign up on our website. Like we said, if you're already an InvestNow customer, then you don't even need to do any onboarding. All you got to do is use your exact same InvestNow login, choose the asset mix that you want, which will be completed in 2 minutes, and then we handle the rest and it all gets done. And you'll get an email as soon as that's all transferred over, and it won't cost you anything. The only cost that you do incur is just simply the fund management fees of the funds that you do select. So for example, if you choose something like the Milford Active Growth Fund, you'll just get charged the fee that Milford charges, which is something like 1.05% per year. Next question. Have you tried to get ANZ KiwiSaver on the platform? Yes, so we definitely have. So I'm in ongoing discussions with ANZ to try and get them on to the platform. As you can imagine, they're quite a big organization and always got a lot on, especially within their investment department recently, which has had quite a few changes to their roles. So at this stage, things are still in motion, but I can't give a definitive timeline yet. All I can say is that we are actively working on it, and I've been in discussion with ANZ just this week. So we're trying to get that on as soon as possible because we do know that it is a very popular option. So as soon as we know more, we'll be sure to share that with you guys. So please watch this space. Next question now. Are there similar case studies shown on the website as examples that they were in the slides? Yeah, so unfortunately, there isn't anything of that nature on the website at this stage. We could potentially, I'll talk to the team, see if we can put something up there. But what we can do is we can definitely send through the copy of these slides to everyone or whoever is interested. Or equally, if there is some specific questions or kind of modeling and graphs that you would be interested in looking, feel free to just fire through an email to me. And I would be more than happy to help out. I'll include my email at the end of this presentation as well. So yeah, just feel free to fire that through to me. Next question. How is the annual government contribution allocated between funds? Yeah, so in terms of the allocation, that's purely up to you. So it depends what you choose for your investment mix. So as we noted earlier, there's 40 different funds on the scheme. So if you, let's say you wanted to use 2 different funds, let's say you wanted to do 50% in the Pathfinder Ethical Growth Fund and 50% in the Foundation Series Growth Fund, then that's how the government contribution will be allocated. So essentially, the money comes through from the government. It gets picked up for our systems. We look at, what did this customer select as their asset mix, and then we split it up accordingly according to that mix. So it could be any combination that you select, which you would select at the first instance when you first join, but equally anytime that you want to change, it's just a simple login to the InvestNow portal, click the funds that you want to see included going forward, and then bam, it's basically good as gold from there. Cool. Okay, next question. Do you have or do any analysis or comparison of the funds? Yeah, so it's a good point. In terms of, I guess, head-to-head comparisons, we don't do anything in depth. We can definitely provide some high-level kind of factual material in terms of, performance figures, standard deviations, but we don't necessarily have anything on the website that would provide like a tool to compare. We do, however, have a fund manager landing page within each manager, which essentially breaks down all the key information that you do need for these funds. For example, like what they're invested in, their returns over the last, 5 years or so, whether they're invested into growth assets or income assets and what percentage, what the fees are. At the moment, we're also working on updating the range of funds page as well. So hopefully trying to get that live in the next week or so, which would basically have all the exact same information that's currently on the fund manager landing pages, but all within one URL or web page where you can basically try and filter all the different funds that you're interested in and then be able to do a comparison that way. But in terms of kind of doing in-depth analysis, we don't necessarily offer that on the platform. But if there is anything in particular that you're interested in, again, feel free to fire me an email or fire our team an email, and we can definitely look at digging that up for you. Excuse me. Yeah, great question though. So what about withdrawal ease on retirement, monthly withdrawals? Yeah, so if you are eligible to tap into your KiwiSaver, then we simply the ability to tap in is purely up to you. So if you want to have monthly withdrawals, then you can just create a sell order into the InvestNow KiwiSaver website, and you'll be able to draw as much of it as you want. Or equally, if you wanted to keep contributing, if you don't feel like you need to tap into your funds yet, then we offer the same thing within the InvestNow KiwiSaver scheme. So it's essentially the portal is completely self-managed, and you can tap into it as often, as frequently as you want once you reach that eligibility age at 65. Next question. Wouldn't having multiple growth funds have a lot of overlap in the underlying assets, therefore lowering diversification? Yeah, so it's definitely a great point to highlight there. So it depends on the specific style. So yes, in one instance, if you have two managers that invest exactly the same in terms of they basically have the same brains, they have the exact same investment processes, they have the exact same thinking at the investment committee level, then yes, you would have a little bit of overlap there. And redundancy, but for the most part, even within growth funds, a lot of managers have completely different investment approaches. So if I kind of go back to that slide we had before about these growth funds, you'll see just how dispersed these blue dots are. And that just goes to show that within each manager's investment process, it can be very different. So just because it says diversified growth within the name of the fund, it doesn't mean that one is going to be the same as the other. So even down to the growth exposure, we have, for example, something like Milfit that has only 63% exposure, versus another one like Salt, which is 80%. So from that sense, this is where we're really trying to highlight the benefits of the power of and approaching these growth exposures across different managers, because there's no one right or wrong answer here. Everyone's got a different approach, and some will do better in some cycles and some will do worse than others. But by being invested across a few of them, you basically just iron out that volatility and make sure you get like a long-term consistent average return there. But yeah, definitely take your point. If there is essentially like two identical managers, then there is a bit of redundancy. Cool. Okay. Next question. Why does InvestNow not charge any fees? How is it financially viable for you as a company? Yeah, so we don't charge the customer any fees because we are super conscious about fees, and we want our customers to be able to just focus on contributing to their KiwiSaver and being able to watch their nest egg grow. The way that our business model works, though, is that we charge the fund manager a distribution fee essentially for being on our platform. Because you're right, it does cost a fair pretty penny to run this scheme. There's a lot involved there, especially with KiwiSaver. There's a lot of regulatory hurdles that we need to jump through with the FMA. But in terms of us being able to sustain this, because we offer essentially these fund managers an avenue and a platform to access a wider audience base, they're happy to essentially pay us a distribution fee, and that's how we're able to basically keep the lights on. So yeah, it's definitely an operating model that's sustainable, so you don't need to worry about the InvestNow KiwiSaver scheme one day just almost disappearing. So on that front though as well, if anyone was curious how KiwiSaver works, if anything does happen to any of the fund managers that you're invested with, the way that the regulatory environment works at the moment is that your assets will still be completely safe. So there's a supervisor for all KiwiSaver schemes, and they will essentially look after your assets, which are always saved in the trust, and transfer them across to another provider if anything happens to your current one. So you rest assured, whether it's with InvestNow or anyone else, your money when it comes to KiwiSaver is 100% safe. And that also goes with the wider InvestNow platform. Everything's 100% safe and saved within a trust structure. Cool. Next question. Can I draw an income specifically from my KiwiSaver on InvestNow? Yep, yeah, so I was kind of touching on it earlier. As long as you're eligible to tap into your KiwiSaver, then it's fully within your rights to draw as much or as little as you want from your KiwiSaver scheme. Again, it's just a self-service option. So if you want to, say 1 month you have more expenses to pay, or you want to go on a nice holiday, then yep, you're free to just withdraw as much as you can. If another month you basically want to try and see your nest egg grow a bit further, then you don't have to withdraw anything. It's all completely up to you. Cool. Next question. Will the Vault digital fund be added as an option for InvestNow KiwiSaver in the future? I understand that mixing an extremely risky and volatile fund is probably not a good idea for KiwiSaver, but would be great to have this option, even if it's limited to say 5% of your total KiwiSaver balance would be fine. Yeah. So it's definitely a great call out. So from our perspective, we have actively looked into this in the past. The kind of hurdles or bottlenecks that we face is really from a regulatory perspective. So the Financial Markets Authority, or the FMA, is quite stringent when it comes to what is offered within KiwiSaver. They essentially don't want anything that is, quote unquote, too much off the beaten path. With something like Vault, and this is not an indictment on them as a manager at all. They're great guys, and they're a really strong, robust process. But just the nature of the underlying asset that they invest in, which is Bitcoin, and the inherent volatility, kind of gives people like the FMA, the heebie-jeebies, to phrase it nicely. There is, potentially some workarounds we could look at. For example, that 5% limit is definitely something that, for example, Sharesies has done within the upcoming KiwiSaver scheme. So yeah, I guess at this stage, never say never. It's part of my job. It's always trying to see what the appetite is in the market, and if I can kind of see that there's a lot of strong appetite for this within the Kiwis out there, then I'll be sure to have that discussion with the FMA and see what we can do about getting that on the platform. And that equally goes to basically any new fund on the scheme. We're always looking out for new ideas and better products, and making adding greater value for our investors. So yeah, watch the space. If there is any specific funds that you'd like to see on the platform, again, feel free to fire me an email or fire out our team an email, and we're always taking on that feedback and planning out our product lineup and initiatives from there. Cool. Okay, next question. Can we do a portion of our KiwiSaver to InvestNow, say 50%, remain to our existing provider, and 50% to InvestNow? Yeah, so unfortunately you can't, and that's what essentially that traditional flaw that I touched on in the beginning prevents you from doing. So at the moment, anytime that you want to invest with your KiwiSaver with any one manager, you're purely limited to that manager's fund options. So you can't be like, I want 50% with my current one, 50% with a new provider. It just doesn't work like that, unfortunately. So the way that InvestNow has kind of gone around that process is that we've tapped the shoulder of all these different managers, let them know that there's definitely an appetite out there in the market for Kiwis to invest across different managers and their funds, but there's just no real avenue to do that in a cost-effective and accessible way at the moment. So that's where InvestNow KiwiSaver came in. We're offering 15 different fund managers options on our scheme. So if you do have, for example, you're currently with a manager that you want to be with going forward, and they're also on the KiwiSaver scheme, then the best way to get exposure to both would be to come across to InvestNow KiwiSaver. So for example, say you're currently with like a Milford, you want to stay 50% for Milford, but also equally you want 50% in like a Pathfinder, for example, right? So if you stay within Milford, you can't do that currently because you're just limited to essentially Milford's funds. Whereas you come over to InvestNow KiwiSaver, we have Milford and we have Pathfinder, right? And we have 13 other managers, right? So you can essentially get that same exposure. And that's the power of AND. It's a great question. Next question now. Are our funds invested or held with the underlying fund managers, e.g. Milford, Fisher, etc., or with InvestNow? Yeah. So short answer, it's all held with the underlying managers. So schematically, how it works is that we essentially create a fund in the back end, and that fund purely invests into the underlying manager. So for example, if you wanted to invest with the Milford Active Growth Fund, then the way that you achieve that is through InvestNow, at least, is that if you invest into the InvestNow Milford Active Growth Fund, then that's purely a fund that invests into the Milford Fund. So the money is purely with Milford. InvestNow essentially doesn't touch it at all. We're essentially just a conduit to allow you guys to access a whole bunch of different managers. And that's across the board for all the 40 different funds that we have on the scheme. Cool. Okay, next question. I see you have funds noted as growth, balance, conservative, etc. Are there value funds also? Yeah, there definitely are. So if I just go back a bit to these slides and just show you the list. So yeah, this is a diversified funds range, and the way that the kind of industry has classified these is you basically go from, from aggressive down to growth, down to balance, down to conservative. That's essentially the risk profile of how much growth assets you want on there. Value is different. That's more of an investing style. So within these specific managers and within these kind of risk profiles, there may be value managers as well. So for example, someone like a SALT, Sustainable Growth Fund, they could apply a value approach to their investing philosophy, or notwithstanding that they're still a growth manager or offer a growth fund. So for example, there could be growth assets like let's say something like a Goldman Sachs or like an Apple, where essentially if SALT or whoever the manager is deems this as a option that when its price in the share market is not significantly higher than their book value or how much the assets are on the balance sheet, then that'll be considered a value-based approach to investing. So that could occur throughout all the 40 different funds we have on the platform. We just haven't broken it down on that basis, but yeah, there are a whole bunch of managers that essentially are value-based on the platform. For another one is, for example, is Clarity. They're essentially a value manager. SALT is similar in that sense, depending on their investing styles. Harbour as well to a certain degree. So yeah, and managers, they can specialize across a few different styles as well. So it just depends on the fund. So you kind of have to read the product disclosure statement to really get the feel for it, or you can feel free to reach out to InvestNow. We can definitely put you guys in the right direction. Cool. Okay, and then next question, just conscious of time, so we probably just have time for another couple questions before we need to wrap up. Cool. So next question, thinking about what happens if InvestNow did fold or wind up in the future, considering KiwiSaver as a very long-term lock-in of funds. Yeah, so I kind of touched base on this earlier. So essentially, if anything happens to InvestNow or any of the managers that you currently have your KiwiSaver with, the way the regulatory environment works is that the supervisor of the scheme will step in, essentially safeguard all the assets, which are always held in trust, and then they'll work through with another existing provider to work through who would be best placed to take on your funds now that the current manager is essentially winding up. So unfortunately, they need to find another provider, because they can't just give the money back to you, because unfortunately a KiwiSaver is locked in until you're age 65. So there's no doubt that your KiwiSaver will still be invested with a provider. It's just that's something that the FMA will look after, and the supervisor, they'll work through, who's the best KiwiSaver, who's best placed in the market to take on this additional KiwiSaver load. But yeah, you can rest assured nothing will happen to your assets. They'll still be there for you, and they'll always be there for you until you're ready to tap into them. Cool. Maybe this might just be the last question. So I started via InvestNow and experienced some delay in the implementation and execution of orders, or maybe just a delay in updating reporting. With KiwiSaver investment being more complicated procedure-wise, are you sufficiently staffed to efficiently carry out the order? Yeah. So it's definitely a great point. So from our perspective, yes, we are all sufficiently staffed. So a lot of it is just basically it's been automated already. So we work with very talented third-party providers in Link, Adminis, and Public Trust, who are our fund custodian, our fund registry, and our supervisor, respectively. And you can find all the information in the PDS as well. So, and these guys work with some of the biggest players in the investment industry as well. So there's definitely no issues in terms of resourcing. In terms of getting delays in implementation, sometimes it can be a bit funny in terms of where you're coming from as well. So from an InvestNow perspective, we only have so much control about bringing the money across. If your current provider does have any issues, or they have any problems with the IID, for example, or trying to get refunds, then it can have some delays. But if there is anything that's kind of sticking out to you, feel free to just reach out to us. We have a customer service team that's here to help out 24, no, not 24/7, 5 days a week, kind of 8 hours a day. So, or you can feel free to send me an email, and I can definitely follow that up for you. Cool. Okay, just conscious of time now, so unfortunately we do need to wrap up. But if there is any other burning questions, feel free to just send me an email. You'll see my contact details here, and I guess from our perspective, we hope you found this session useful today. If you are interested in joining the InvestNow KiwiSaver scheme, check out our dedicated landing page for this at investnow.co.nz/KiwiSaver-better futures. So, and if you want to basically get the benefits of fund manager diversification, super low scheme expenses, and the breadth of choice of 40 different funds, then join the InvestNow KiwiSaver scheme today and unleash the power of AND. Thank you so much, guys, and we'll hopefully see you guys in the next presentation. Cheers.